Hello, everyone, and welcome to Financial Accounting. Today, we will continue the topic, accounting for merchandising activities, and take a closer look at purchasing merchandise, including credit terms and cash discounts, and recording purchases at net cost versus the gross invoice price method. If you haven't had a chance to watch the video, Accounting for Merchandising Activities, where we discuss the perpetual and periodic inventory systems, follow the link that I'm posting right here and in the description box of this video. Let's quickly review the operating cycle. The business's operating cycle is the time it takes a company to start with cash, purchase inventory, sell the inventory, and finally collect money from customers. Today, we will look at the purchasing of merchandise. Merchandising companies purchase the inventory they sell in a ready-to-sell condition. Since they don't have to make the inventory, their operating cycle is typically short. Now, let's look at credit terms and cash discounts. Cash discounts are provided to customers as an incentive to pay early. The credit period is the standard period when a company allows customers to extend their accounts receivable, usually 30 days. The discount period is much shorter, usually 10 or 15 days. A discount may be taken if payment is received during the discount period. If payment is made after the discount period expires, then the entire amount is due on or before the end of the credit period. Cash discount terms are typically written as shown on this slide. It is read as 2, 10, net 30. The first number represents the discount percentage. The second number represents the discount period. The letter N stands for the word net. The last number represents the entire credit period. In our example, if the customer pays within 10 days, then a 2% discount may be taken. If not, then the entire amount is due within 30 days. If a company has extra cash to make a payment earlier, it is recommended to take advantage of the discount, as the annualized rate is usually much higher than you can get in a bank. Keep in mind that you are getting 2% for 20 days. 2% is not an annualized rate. The formula used to calculate the annualized rate is the amount of discount divided by the discounted price and multiplied by the number of days in the year over the number of days paid early. Let's say you have a $1,000 invoice. You would receive a $20 discount if you paid it within 10 days. The annualized percentage is calculated as follows: 2 divided by 98 and multiplied by 365 over 20 equals 0.365 or 36.5%. According to this formula, taking the 210 net 30 discount is the equivalent of an effective annual return of more than 36%. So the answer is yes, you should take the discount unless you can use the funds to get a better return. Sometimes it makes sense to borrow money to take advantage of the early payment discount. Now, let's look at the accounting side of recording purchases. Many companies plan to take advantage of cash discounts and record their purchases net of discount. Since they typically take the discount, this process simplifies future entries. If a cash discount is not taken in the future, then a purchase discounts lost account is used. Let's look at an example. On July 6, Jack and Jill purchased $4,000 of merchandise on account from kids' clothes. Payment terms are 210 net 30. Jack and Jill debits inventory and credits accounts payable for $3,920, which is net of the 2% cash discount. On July 15th, Jack and Jill pays the total amount due to kids' clothes. In this entry, Jack and Jill debits accounts payable and credits cash for $3,920. Since accounts payable was initially recorded for the net amount, this entry takes care of the balance in the accounts payable account. No further adjustments are required. Let's look at how these two transactions are recorded in the ledger accounts or T accounts. Inventory is an asset and is increased by debit. Cash is also an asset and is decreased by credit. Accounts payable is a liability account. It is increased by credit and decreased by debit. We increase it when we initially record the purchase and decrease when we pay off the vendor's invoice. Note that the amount of debit or decrease must be the same as the initial purchase amount, as this account needs to be closed when the invoice is paid off. There is no more open liability for the invoice. It is essential to reconcile the accounts payable aging report that lists all invoices with the ledger for accounts payable to make sure all invoices and payments were recorded correctly. How is it going so far? If you like this video, press on that like button so I know what you think. Now, assume that Jack and Jill waited until July 20th to pay kids' clothes. This is outside the discount period. Jack and Jill will have to pay the total amount of $4,000 since they didn't pay within the discount period. This is recorded as a credit to cash. The debit to accounts payable can only be for the initially recorded amount of $3,920. The difference is a debit to purchase discounts lost, an expense account for $80. Let's look at the T accounts again. Notice that we now have a new account, purchase discounts lost. This is an expense account and is debited or increased for the difference between the amount paid and the balance in the accounts payable account that was initially recorded net of discount. Same as in the previous example, the balance in accounts payable is zero after invoice is paid. Some companies prefer using the gross method to record their purchases, particularly when they don't expect to take the early payment discount. Under the gross method, the purchases are recorded initially at the full amount of the inventory purchased. If a cash discount is taken in the future, then a purchase discounts account is used. Let's look at how purchases are recorded under the gross method. On July 6th, Jack and Jill purchased $4,000 of merchandise on account from kids' clothes with terms 210 net 30. Jack and Jill debits inventory and credits accounts payable for $4,000, which is the gross amount of the purchase. On July 15th, Jack and Jill pays the total amount due to kids' clothes. Jack and Jill doesn't have to pay the total amount of $4,000 since they are paying within the discount period. As a result, the credit to cash is $3,920, which is the net amount. This payment removes the entire accounts payable of $4,000 and is recorded as a debit to accounts payable for $4,000. The difference of $80 is a credit to purchase discounts taken, an account that reduces the cost of goods sold for the period. Remember that the accounts payable account needs to be debited for the same amount it was initially credited to close the account as you don't owe for the purchase anymore. Let's look at T accounts. Because the gross invoice price method is used, inventory is debited for the total amount of $4,000, and accounts payable is credited for the full amount as well. When the invoice is paid early and the discount is taken, we still need to debit or decrease accounts payable for $4,000 to close it. Notice that the balance in accounts payable after the invoice is paid is still zero. We pay $3,920 as we took the discount. The difference is recorded in the purchase discounts taken, which is a cost of goods sold account. Since we paid less than was initially planned, we need to record the difference as a decrease or credit in the purchase discounts taken account. Now, assume that Jack and Jill waited until July 20th to pay kids' clothes, which is outside the discount period. In this entry, Jack and Jill debits accounts payable and credits cash for $4,000. This payment must be for the gross amount since it is made outside of the discount period. Let's look at the T accounts. In this case, the payment was made outside of the discount period. Inventory and accounts payable are recorded at the total price of $4,000. When the invoice is paid, accounts payable is decreased or debited by $4,000, and cash is decreased or credited by $4,000. Same as with previous examples, the balance in the accounts payable account is zero after the invoice was paid. In general, the cost of any asset includes any transportation costs related to getting the asset to the buyer's place of business. This is also the case for inventory. Transportation costs incurred by the buyer are included in the cost of inventory. That's all for today. Thank you for watching this video. Don't forget to like and subscribe so you don't miss future videos. Feel free to forward this video to anyone who is interested in learning accounting. I will see you in the next video.